Hello everyone. Today we are going to talk about pre-qualification, pre-approval, and a third option that might be even better than both. So stay tuned and here we go. Qualification is essentially you call your bank or you call a lender, but it's usually the big banks that kind of do this practice. It's not so much the direct lenders. You give them a call and they ask you some questions. They write down your information. They might run your credit report. Usually that might be a part of the process. And then they basically tell you, okay, based on what you told me over the phone, based on your credit report, this is about what I think you can purchase. So here's your pre-qualification letter. You can purchase up to X based on what you told me in your credit. And that's it. Okay, here you go. That's pre-qualification. So in my opinion, over all the different things you can do, it is definitely better than never talking to anyone, which some people try to buy homes without talking to a lender. Some people are able to do it. A lot of people aren't. And a lot of sellers usually won't take an offer from someone who hasn't spoken to an institution about where the money's going to come from. Okay, unless you just have a big old pile of money and you're going to buy cash, they'll take that all day long. So what is the point of doing that? So the pre-qualification is it's just the first step. The next step in that process is to get pre-approved. Now, being pre-approved means you talk to someone on the phone, they probably ran your credit, they had a conversation over all of your details, your income, your employment history, your assets, how much you're looking to buy, who's all going on the loan, stuff like that. All the important nuts and bolts that come together for your pre-approval. Now, the question then becomes, okay, well, I need to see your documentation to back up everything you've said so we can use precise numbers with what your income is, so we can use precise numbers with how much money you have saved, or if you're getting a gift, where's it coming from and how much. We're definitely going to look at your credit report. We're going to kind of go through that and make sure everything's all good there. We might even try to pull a verification of employment from your employer and get your income completely broken down if you've got different types of income coming in. If you're self-employed, I'm going to pour through your tax returns and I'm going to look at them to see what kind of income I can use. I'm going to put it all in my system. I'm going to run it through automated underwriting systems that'll tell me if it's a yay or a nay. And that's the point you have to get to be pre-approved. Most listing agents, most sellers want to have a pre-approval letter with your name on it for how much you can buy when you submit an offer to a home. It says, look, I've done the work, I've done my homework, I'm good to go. You can accept my offer because my financing is right behind me and it's ready to go. That's what it means to get pre-approved. Now, there is a third option that might even be better. Actually, it is better than the other two. Not in every situation because it may not be needed, but it is a good one. So real quick, if you like this video, if you like the content, please like it. Share this with someone you know or that might be looking to purchase a home. They're talking about it, but they don't know what to do. They don't know where to go. This channel, I've got lots of videos on there on the whole process and what to look for, and it's just stuff to educate you. I'm not selling you anything. It's just something to share with people so that they can understand what they're getting into and what to expect. So subscribe to the channel if you haven't already. But let's talk about this third thing. This third thing is called conditional approval. You can get a conditional approval. Now, what does that mean? It means you called someone on the phone. They've looked at all your documentation. They've run it through an automated underwriting system and it says it's good to go. Or it didn't, but it seems like it should. Maybe we need to escalate it. Maybe we need to have this actually go through the process and have an underwriter look at it and say, yes, everything looks good. You're conditionally approved to purchase a home. So there's no property involved when you get conditionally approved. What the underwriter is doing is underwriting you. They're underwriting your situation, your income, your assets, what you're looking to do, how much you're looking to buy. They figure out all those numbers ahead of time. They say, yes, you are conditionally approved to purchase a home for X. So then when you go to find that home and you find it and you put an offer on it, boom, you're like, I'm already conditionally approved and underwriter's already reviewed my stuff. We can close escrow faster, usually. Because now what's going to happen is the underwriter is going to look at the contract and they're going to look at the property and they're going to look at the appraisal and what that comes back for. That's a lot less work than evaluating the whole person and everything about their system. So everything about what their income is and their assets and their credit. If that's already done, they're just looking at the property and the contract and making sure it's good, you're good to go. So conditional approval. In situations where you might have a complicated income streams. Let's say you own a couple rental properties, you own a couple businesses, your credit history is not that great, and the pre-approval process, it seems like it should work and it's not working, but your loan officer says, you know what, this should work. Let's go to that next level. Let's get you conditionally approved. Another way of calling it is a TBD approval. It's to be determined based on whatever property you find. But you yourself, your information, it's underwritten. So it's a very cool tool to use. If you're in a very competitive market, lots of buyers, not a lot of inventory of people are trying to buy homes, and you're getting beat out. You got 3, 4, 5, 15, 20 offers on one house. Sometimes the highest and best isn't always going to be whoever offers the most money. Sometimes it's going to be who can close the fastest. If I have 10 offers in front of me and one of them's cash, and it's cash for less than what I want, but I can close it in 5 days, I might go for it just to get it done. But what if I don't want to close in 5 days? What if I just want someone who's already kind of gone through the rigors and they can get through the process, they have the financing, and they can just do it faster? What if they can close in 2 weeks? I might just take that one over the person who's offering more money, because it's going to take them 30, 45 days, maybe 60 days, because maybe they're selling a house and they got to wait for their house to close. A lot of variables involved. So getting conditionally approved, that's going to be a very, very powerful tool, especially in a market where it's a seller's market. You have not that many houses out there, lots of buyers are trying to buy. So it's a lot of competition. Whatever can set you apart can help you compete. If you're competing and you're on kind of the same playing level and there's not a whole lot of stuff that you can do that kind of sets you different from everyone else, you're going to have a hard time getting your offer accepted. So those are just some of the things that you got to deal with when you're looking to buy a home. But that's the difference. Pre-qualification isn't really worth much. It's really just a step. It's really just the first step to get things going. It's that first conversation. It's the story behind what it is you're looking to do. Because more often than not, your documentation may not it may not tell the same story. It may not give you the same numbers. It could be the difference between finding something in the area you want to buy and finding something that's 20 miles away from there in a worse neighborhood, because maybe the houses aren't as expensive. Things like that can really move you around, and it can really just depend on your documentation is just slightly different than what you thought it might be. Your income might be really great right now, but it wasn't great last year. And so when we look at it and it has to be averaged, if it's really volatile, now you're not qualifying for as much. Now maybe you can't buy as much as you wanted to. Or in a market like this where everything's appreciating very quickly, you might get squeezed out of what you want to get. And we want to avoid those things if we can. So speed is of the essence. So pre-qualification, it's not really worth much. Move past that. At least get pre-approved before you go to buy a home. And if you're really gung-ho, the only real difference is you have to sign some disclosures. You got to submit your paperwork like you do with pre-approval. You got to sign your initial disclosures, which aren't based on a property. It's based on kind of a scenario. And then it goes through underwriting. And the underwriter might say, yes, this is conditionally approved, but give me some more documentation when the time is right. You're good to go. So those are just your different options there. Hey, if you got any value out of this video, please like, subscribe, share it with someone that you know is going through this process. They might be overwhelmed. They might have questions. This is a good resource to help them out. But yeah, so we'll see you guys in the next video. But yeah, take care.